How one trader broke a 233-year-old bank. The Barings Bank collapse. What if the reckless actions of a single individual could bring down a financial institution that had stood for more than 2 centuries? Imagine a bank so venerable, so deeply woven into the history of global finance, collapsing within months because of one trader's risky moves. This is no fiction. It's the true story of Barings Bank, Britain's oldest merchant bank, which had survived revolutions, world wars, and economic upheavals for 233 years, until Leeson, a young derivatives trader, brought it crashing down in 1995. How could such a disaster happen in a place as prestigious and supposedly prudent as Barings? The story unravels an intricate web of risk, secrecy, and misplaced trust, exposing the vulnerabilities at the heart of high finance. Barings Bank was founded in 1762 and quickly made a name for itself as one of the most respected financial institutions in the world. It was often referred to as the sixth great power because of its pivotal role in financing governments and major projects, from the Louisiana Purchase to the expansion of the British Empire. The bank's reputation was synonymous with stability, sound judgment, and old-world integrity. However, by the 1990s, the banking industry was rapidly evolving, with new financial instruments and markets emerging, especially in derivatives trading, contracts whose value is derived from underlying assets like stocks, bonds, or commodities. Derivatives offered enormous profit potential, but also significant risk. In particular, futures contracts on the Singapore International Monetary Exchange, or SIMEX, became a playground for aggressive trading strategies. Barings Bank's operations, however, remained rooted in traditional banking culture, with less emphasis on rigorous risk control systems for these new complex products. This gap would prove fatal. At the center of this storm was Leeson, an ambitious British trader stationed in Barings' Singapore office. Leeson was officially hired to conduct arbitrage, exploiting small price differences between futures contracts on different exchanges to generate steady, low-risk profits. But instead, he embarked on a secretive quest for increasingly large, risky trades that led to catastrophic losses. To understand how Leeson did this, we need to dive deeper into the mechanics of derivatives trading and the institutional failings that allowed him to operate unchecked. A derivative like a futures contract obligates the buyer or seller to transact a particular asset at a predetermined price on a future date. Traders often use these contracts to hedge against risks or speculate on price movements. For instance, a coffee producer might sell futures contracts to lock in future prices and protect against price drops. Conversely, a trader might buy futures betting that prices will rise. But futures trading requires constant margin payments or collateral, and markets can be volatile. Losses can quickly multiply if price movements are adverse. Now, Leeson's job was to find so-called arbitrage opportunities. This means exploiting price discrepancies, theoretically creating riskless profits by buying low on one exchange and selling high on another. But Leeson went far beyond this low-risk strategy. He started making enormous speculative bets on the direction of the Japanese stock market, particularly using Nikkei futures contracts on SIMEX. He essentially gambled that the market would rise, buying futures contracts in the hope of profit. What made this more dangerous was Leeson's unique role at Barings. Not only was he responsible for trading these futures, but he was also in charge of back-office functions, the department that should have been monitoring and verifying his trades and positions independently. This glaring lack of segregation of duties meant Leeson could both make trades and hide losses, manipulating records to present a facade of profitability. When his speculative bets went sour, instead of reporting losses, he started booking them in an error account, known only as Account 88888. He kept the real extent of the losses hidden from Barings' London headquarters. Initially, Leeson tried to recover losses by doubling down on even bigger bets, a desperate attempt to turn things around. This strategy failed spectacularly when the Japanese market plummeted after the Kobe earthquake in January 1995. Instead of containing the damage, Leeson's losses exploded to more than £1 billion, or roughly $1.3 billion at the time. By February 1995, the losses were discovered and the bank found itself insolvent, unable to cover the void. Barings Bank was declared bankrupt after 233 years of operations and was ultimately sold to the Dutch bank ING for a nominal £1. The case of Barings Bank is not just about reckless trading, it's about systemic failure. The bank's internal controls were woefully inadequate. The lack of proper segregation of duties gave Leeson a free hand to hide losses. Furthermore, senior management and auditors failed to ask tough questions about the unusually large and secretive positions Leeson was taking. This was a failure of corporate governance, risk management, and oversight in an era when financial institutions were still adjusting to the complexities of modern derivatives. Historical examples provide a sobering context to the Barings collapse. A nearly comparable scenario played out decades later with the collapse of long-term capital management in 1998, where high-risk derivatives and inadequate oversight nearly brought down global financial markets. More recently, the London whale scandal at JP Morgan Chase in 2012 involved massive losses exceeding $600 million due to risky derivatives trading. These events echo the lessons from Barings: the enormous potential dangers of unchecked trading desks, obscure risk management, and the thin line between ambition and catastrophe. Beyond the immediate financial loss, the collapse of Barings Bank sent shockwaves through global finance. It was a wake-up call for regulators worldwide, leading to tighter scrutiny of derivatives markets and greater emphasis on internal controls. For example, the Basel Committee on Banking Supervision reinforced requirements for risk management, capital adequacy, and transparency following such incidents. It also accelerated the professionalization of financial risk management as a specialized field. Barings' story underlined how interconnected global markets had become, where the failure of a single trader halfway across the world could jeopardize an institution rooted in London. The crackdown on rogue trading led to industry-wide reforms and technological investments in real-time risk monitoring, aiming to prevent any one person from wielding unchecked power over a bank's fortunes. Moreover, this scandal influenced how financial institutions approached staff recruitment, compensation, oversight, and ethical training, policies designed to curb the temptation to circumvent controls for short-term gains. For individuals, the story of Nick Leeson and Barings Bank is a cautionary tale as much as it is a riveting drama of high-stakes finance. It reminds us that in economics and investing, not all risks are created equal, and cheap shortcuts can have devastating consequences. Whether you're managing your savings or running a business, the principles of transparency, oversight, and accountability are essential to long-term success. It also raises deeper questions about trust in financial markets. How much faith should we place in institutions, and how vigilant must regulators be to keep the system honest? In a world where financial products grow ever more complex and technological innovation accelerates trading speeds, the risk of another Nick Leeson lurking in the shadows remains real. So the next time you hear about a major banking failure or a scandal involving reckless gambles, remember Barings Bank, a 233-year-old institution felled by the risky bets of one man operating in secrecy. Could similar vulnerabilities exist today, waiting for a spark? How can the lessons from this historic collapse guide our financial systems toward greater resilience and integrity? The story is not just about the past. It's a mirror reflecting ongoing challenges in global finance. The takeaway here is that transparency, oversight, and accountability are crucial in both personal finance and business management to prevent catastrophic failures. We must remain vigilant about the institutions we trust with our money and the risks they take in our name. As complexities in the financial world continue to grow, the lessons from Barings Bank remind us to prioritize caution and integrity in all financial dealings. If you found this story interesting, hit that like button and subscribe so we can keep making these videos. Tomorrow, we are diving into a story that is just as shocking. Archegos Capital Management, the $20 billion margin call. You will not want to miss it. I will see you there.